Okay, so good morning, everyone. Welcome to the macro snapshot. This is Friday, January the 16th, 2026. Of course, recording this in the morning about 7 o'clock. Okay, guys, I just want to have a look and see what's going on with the Fed pricing, which we have here. Just bring that up and just have a quick overview of the data. I mean, what generally the data seems to be telling us about the United States economy is that it's in some sense just sort of slowly and gently expanding. It's not sort of massively growing, but on the other hand, we have zero evidence of anything resembling a recession. I mean, and just recently, for example, yesterday we had the retail sales, which came in, relatively strongly. Or actually, a couple of days ago, retail sales came in relatively strongly. We had initial jobless claims, which are doing well. We had the Beige Book, which presents, a picture of the U.S. economy as the labor market relatively stable and sort of industry and sort of services picking up, as I say, in a gentle way. So overall, U.S. economy looking really good. Relatively stable. And if we just look at the pricing, this is actually a snapshot from yesterday, but basically you see here the pricing for the Fed, nothing priced in for the January meeting here. You see sort of a lot of zeros here. And the first cut is not really priced in before, let's say, June to the July meeting here. So 17th of June, the 29th of July meeting, you see about, sort of one cut priced in, which equates to, around about between 22 and 30 basis points of cuts. And if you start looking at the terminal rate, we'll look at a SOFR chart in a second, something maybe like December of 26, but you see that the second cut is priced in, but it's not until Christmas or December of 2026. So essentially what the market is saying at the moment is that, yep, the Fed will cut once or twice, most probably over the course of 2026. The economy is doing relatively well. The labor market is relatively robust. And so then we have to balance all of that with talk about, sort of an incredibly dovish Fed, which is going to be dominated by sort of puppets of Trump. We'll see. And we all know the drama there. We won't talk too much about that, but that's just generally the overview. And if we look at just how the market has repriced, if we look at something like, I want to look at a sort of a SOFR chart, and I'm just going to pick here December of 2026. So the SOFR, of course, is the 3-month short-term sort of overnight finance rate here. And we can just see here that the implied rate, so this is the implied rate, not the price, the implied yield on that is 3.225. So what you can see is that yesterday, for example, we had a sort of a strong push up in the yields on the back of that initial jobless claims. The Philly Fed was also quite strong yesterday. So if we look, let's say, just bring this up here. If we look at how that's changed, let's say over the last, 4 or 5, 6 trading days, we can see that that's gone up about 12. That's about a half cut there. So that's 12.5 basis points more hawkishly cut. More hawkishly sort of priced in. And if we go back to something like, I don't know, let's just go back to something like, mid-October or so, you can see that the market has repriced in a hawkish way about 36 basis points, which equates to about 1.5 cuts less. So the point is that here the market over the last 3 to 4 months has essentially said, hey, the US economy is doing okay. We don't need to be as dovish in terms of Fed pricing. So if you look at any of the SOFR curves, you can see how they've changed. And as I say, looking at the terminal rate now, that is definitely sort of going up as we speak. So that's indicating confidence in the US economy. And that's being reflected a little bit if we just keep on the FX space here. If we look a little bit here, let's say, for example, the US dollar, and we can see here that the dollar index, which, is about 58%, euro with a little bit of sort of Japanese yen and the pound and the Canadian dollar thrown in. You can see that overall in the last week or so, that's actually gone up. It's shown a little bit of strength, on the back of, sort of hawkish repricing for the Fed. And I would also say on the fact that the US economy seems to be, the data seems to be telling us that it's doing a sort of okay. And what we can see here, just from a technical perspective, is that it was rejected sort of yesterday at 99.4, which is the 61.8 fib retracement from, if we sort of if we anchor that on from 21st of November. So at this point, we've had a nice sort of fib retrace, but now facing resistance. So the big question now is what happens. I would say from a technical perspective here, let's break this down to a 4-hour chart. Really what needs to happen now, as you can see here, we are still technically in a little bit of a sort of an uptrend from the last couple of months or so. But really what needs to happen now is this a simple retrace, or will the bears sort of take control again? And I would say probably, a sort of a relatively sort of simple way of doing that. Again, I'm just going to throw this on the 4-hour chart, is to look at a couple of fib retrace levels here. So where do the bulls have to pick it up? Where do we have technical damage? So if I anchor this from, let's say, the 12th of January, this last recent impulse, you can see here that we're now at the 38% fib retrace. So that's the first level where the bulls could come in at 99.18. Otherwise, this is an interesting level here at the 50% fib retrace, basically 99. So where would they be in trouble? I would say that the bears would regain sort of traction anything lower than 98.95. If it gets down below there, you'd have to say that maybe the dollar could fall off a little bit. And of course, we do have this other level down there. So they're at 98.7. So they're the four different levels I'm looking at for the bulls to come in and step in. So let's just keep and see if it passes that test. Right now, in terms of de-dollarization and just this whole dollar theme, we did get a bit of tick data. So that's tick data we got yesterday, and that's essentially the inflows of sort of assets, of foreigners buying sort of US assets, so treasuries and, sort of equities and whatnot. Now, this is a very volatile data set, but basically for the numbers for November, the net foreign purchase of US assets was actually positive $100 billion. So keep in mind that there are a lot of narratives out there saying, China is divesting and no one wants to buy US equities, and the, de-dollarization and BRICS and Russia and all of this kind of stuff. But the reality is that the most recent tick data we had, TIC, is, as I say, it was a positive inflow of $100 billion. Now, a lot of that was into the US equity space. So, there's still foreigners sort of buying equities. But having said that, if you look a little bit more detail at the US treasuries, we can see that the BRICS nations are, sort of selling. And if you look at overall the tick data for 2025, you can see that, there were sort of selling from India, from China, from Brazil. On the other hand, we had a sort of net inflows recently in the treasury space. From Japan is still big as sort of holders and buyers. We had Saudi Arabia, the UK, but we had a lot of buying from Canada and Norway. So, is there some de-dollarization and sort of net selling of US treasuries by the Chinese and the BRICS nations, India and Brazil? Yes, that is true. Overall, foreigners still sort of net purchases of US treasuries. Yes, that's happening with, Norwegian pension fund, sovereign debt fund in the UK, Japan are still buying US treasuries. So the de-dollarization story is happening, but I would say this is really going to be a 20 or 30 or 30 years, so a multi-decade sort of move away from the dollar. I think it's difficult to trade this on a sort of a daily basis, but it is interesting to keep an eye on that. On the other hand, are there any short-term threats to US dollar strength? Yeah, for sure. So one thing we can look at is just want to look at just a couple of potential interventions. If we look at the situation in Japan, so let's just look at the situation in Japan here. So if we look at the US versus the JPY, we can obviously see that this very key level, if we just scroll back here a little bit, we can see that this is a very key level upward resistance of 158. Let's call it 159, basically 159. Now, is this intervention by the Bank of Japan or the Ministry of Finance? I don't think so at this point, because really their structural problems are such that if they intervene, could we get a 2 or 3% pullback in USD JPY? Yeah, that's absolutely possible. But structurally, the Bank of Japan is still trying to do some form of soft yield curve control. There's still too much sort of a bond issuance and all of that kind of thing in Japan. So I don't think that makes sense for them. But, could they intervene? There's been some jawboning and a verbal intervention overnight. So maybe there's a little bit there. But really what we have to look at is a slightly bigger picture of the election. It looks as though Takeichi from the Liberal Democrat Party will dissolve the Diet, so the lower houses of Parliament, and call a snap election, maybe for the 8th of February, which actually is only about 3 weeks away, say. So that's a snap election, and she's hoping to consolidate and to strengthen her position, so she can, without the aid of coalition partners. So the thesis here is that if the LDP, the Liberal Democrat Party, which is Takeichi, if she does actually get a majority, or at least strengthen her position in the lower house in Japan, that will enable her to put into place the more stimulatory sort of policies which she wants. She wants more sort of a looser monetary policy and more fiscal stimulation. And the logic here for the FX market is that the logic here for the FX market is that this could be sort of a negative for the Japanese yen, so strengthening for the US dollar, just because the idea here is that the Japanese authorities will actually issue more long-term bonds, pushing up the yields, but basically causing the market to worry a little bit about the sustainability of this sort of loose monetary policy, which is going to be the safety valve here will be the Japanese yen. So let's keep an eye on the elections of the next 2 or 3 weeks. Well, as I say, they haven't been announced yet, but if that happens, but that's really what the market is trading on here. Excuse me, at the moment for the USD JPY. On the other hand, of course, it looks as though some of the opposition parties are starting to band together to present a united front. And if they were to perform more strongly than anticipated in the elections and the LDP less strongly, that could actually be sort of a positive for the Japanese yen. So it's a USD JPY coming back. At that point, we could see some intervention from the Ministry of Finance, the Bank of Japan, and that could drive down the Japanese yen for sure, maybe a couple of percent, so 2 or 3%. So maybe you're talking, something maybe even down to 155, 154. Some of these levels down there looks interesting, 154.50, something like that. Now, at that point, will the bulls come in and the macro position reassert itself? It's possible, but that's where we're looking for. Okay, just in terms of other stuff, just want to have a quick look in terms of intervention in the US dollar. Very, very quickly, just looking at something like USD KRY, which is the Korean won. And the only reason I'm mentioning this is because you see here that the US dollar, it collapsed here. There was a talk from Besant, the US Treasury Secretary, but you can see here it's immediately sort of pushed much higher. And so the Korean won getting quite weak here at this point. And as you can see here, getting up to that key level, a lot of people say that 1500 here, you see just up here, is the line in the sand. So talking about intervention, it's not only sort of concerns about the Japanese Ministry of Finance intervening, but also possibly the Bank of Korea intervening. If we do get up to that 148, 140, 1,490, even 1,500 level, potential intervention here in the Korean won, just because the US dollar is getting way too strong there. And it doesn't really reflect what's going on, because just quickly, if you have a look here at the, for example, something like the stock market, like the Kospi here, it's doing incredibly well here. And you see it's just relentlessly pushing higher. So, at least in the export space, in the semiconductors, what is it, Hynix and Samsung doing incredibly well. And as long as, just to put it, something like the SOX index here of the semiconductors, which you can see essentially is being over, it's very highly correlated with the Kospi, or you can say the Kospi is very highly correlated with the semiconductor index. So it does seem a little odd that the Korean won is so weak. So all of these things are tied together. Let's keep an eye on the Kospi. Let's keep an eye on the SMH or the SOXX, so the semiconductors indices, and just see if that's justifying such a weak Korean won. Of course, the fact that the Korean won is so weak is also enabling some of these Korean exporters to gain a bit of a competitive advantage. So that's something to keep an eye on here. The other thing you just want to have a look at here, just talking about some of these currencies, is the euro. So let's just bring up the chart here for the euro. The euro seems to be in sort of a large trade range. You can see here going back, maybe sort of 6 months or so back to the middle of last year. It looks as, something, let's say about, 118 and a half. And on the bottom end of the range seems to be about, let's call it about 115. So trading within, that 118, 115 band here. We've come to an interesting level technically. You can see here that in terms of the technicals, we've now reached at about 116. You can see here this is in the fib pocket between the 61.8 and the 65% fib retrace here. So that could be a little reactive bounce. Now, if it were to do a little reactive bounce, is that indicating sort of signs of positivity, or is it just, as I say, just as of a technical bounce? And what we could look at here, where would the what do the bulls need to do? I would say, as usual, the first sort of interesting level would be the fib retracement level here, the 38%, which is at about 116.75. So 116.75 for the euro USD. That's the first hurdle which the euro bulls need to overcome to sort of prove that this is anything more than a tiny reactive bounce. And really, in order to signal sort of true bullishness, I think we'd have to see it clear the 61.8 fib retrace level, which is up at about 117.25. So that's what I'll be looking for and keeping an eye on just at the moment. But just talking about the euro, It's interesting to think in terms of the carry trade and volatility because at the moment, if you look at the 1 month implied vol on the euro, it's trading at about 5%. So a 5% vol. So that's relatively low, and so that's a positive environment for funding carry trade. So the idea is here is borrowing, let's say, in the euro and looking for sort of emerging markets, emerging market sort of currencies like the peso or something like that, which are much higher yielders. So if we look at some of these, and just while we're talking about this, we can look at something like the USD Mexico, Mexican peso, which has absolutely collapsed. I mean, just look at this: the US dollar versus the peso has been all one-way traffic towards the downside, a weakening in the US dollar over the last, sort of 6, 12 months or so. And if you also look at something like the South African rand, you can see here the US dollar also has weakened significantly, breaking through levels. So this is really very significant here. You can see that's getting down to a pretty key level, which I've marked down here at about 16 or so on the South African rand. But also you can see here the Mexican peso versus the Japanese yen. Just straight up. I mean, this is a pretty crazy chart. And that's just because, what people are doing, institutions, obviously mainly, but also sort of retail in a certain sense, borrowing in the low funding, in the low yielding currencies like the euro and the Japanese yen. And then, buying, sort of the South African rand or the Mexican peso, which are or the South, which are yielding more. But that's also a question of volatility. If the volatility starts to pick up in the funding currency, that becomes less attractive. So the point I'm trying to make here is that the euro, with a volatility of about 5% priced at the moment, compare that to, let's say, the yen, where 1 month implied vol at the moment is 8.5%. So that volatility is picking up the yen. We talked about election risk. We talked about the risk of intervention. And so that's making the yen as a funding currency a little less attractive, because what you want in the funding currency is a stable, low volatility environment. You don't want any problems there. And so my point being is that this could be a slight tailwind for the euro, because as a funding currency with low volatility, that's going to be more attractive incrementally versus a high volatility regime. And the other issue here is that at the moment, the euro, it's costing to fund about 2% or so. That's where the rates are. If you look at the short-term interest rates in euro, it's about 2%. Now compare that to something like the US, where it's about 3.55 for the cost of funding. So US, if you want to borrow in US dollars and let's say buy Mexican peso or South African rand or Chilean peso, something like that, it's going to cost you about 3.55% to fund that. Whereas the euro, which we saw has low volatility, is about 2%. So the point is that it's an interesting sweet spot here for the euro as a funding currency. Although, on the other hand, we have to be looking at some of these charts, because if there's any sense that the Japanese yen is getting too volatile, BOJ intervention, or any problems in, let's say, South Africa or Brazil, something like that, we could see an unwinding of this carry trade. And that also means that money would, quickly go back into the yen. We could see a spike in the yen, like a very aggressive spike in the yen. And also, as mentioned, because the euro is a relatively popular funding trade at the moment, we could also see people getting out of the long position and putting money and then buying euro to get out of that position. So keeping an eye on the euro and the Japanese yen at this point, especially against some of these cross pairs. Okay, so just to finish off here, guys, just quickly looking at a couple of other markets here. As I say, fairly sleepy at the moment. Volatility is relatively contained. You see, we had a bit of a spike a couple of days ago, but vol in the in terms of the VIX, at least, down about 15.7 as we speak. So around about a 1% move on a daily basis expected there. I just want to show a bit in terms of a couple of other markets here. Sorry, just having a quick look here. You can see the S&P, again, trading along the highs. It's done nothing sort of wrong at all, but just finding a little bit of overhead resistance here. Similar kind of situation here with the NASDAQ, which is, doing okay, but just seems to be grinding sideways. Really what we're seeing here is strength in something like the Russell and the equal weights. If you look at something like the equal weights, I think I showed it yesterday, the RSP, you see that's trading to highs in the pre-market up to the psychological 200 level. You can see that the breadth of the market, you see above the 50-day moving average, 72% of companies above that. So overall, what we're seeing a rotation into small caps and equal weight and more breadth. Now, where could the Russell go? I mean, someone was asking me. I mean, just at least from the technical perspective, if you do a measured move, Fibonacci, we have reached the first kind of Fibonacci sort of extension, the 61.8 at about. So you could argue that, a bit of profit taking, but there's absolutely nothing technically to stop the Russell, let's say, from going to the top of this channel, which would be the full Fibonacci measured move up to 27.97. Let's call it 2800 or so. That's technically not, impossible. Now, will it go in a straight line? Obviously not. But as long as we have these dips being bought, this is still a very bullish chart. And we throw on a couple of, let's say, for example, just like the EMAs and whatnot, you can see here that we're well above all the EMAs, all the trends are pointing upwards. So, this is a very positive chart at this point. No reason why I can't continue. Global equities doing well. We see sort of, the Euro stocks also sort of trading positively. And just looking at the Nikkei, you can see here, we've spoken about Japan a little bit. You can see the Nikkei basically at highs, taking a little bit of pause, but the Nikkei doing very, very well. And that's because, the fiscal stimulus and the weaker yen is really, a pretty powerful a tailwind for Japanese stocks. We're getting quite a lot of foreign inflows into Japanese stocks as well. So in terms of where that could go, again, look at the moving averages here, that's still positive, and so that could continue to push a little bit higher. Just a couple of other things to look at here, just in terms of the oil market. We know there's been quite a lot of headlines in Iran. The reality is that oil, it was rejected at that overhead resistance 62, obviously on Iran headlines and whatnot, and this idea that there is still a bit of a surplus in terms of global supply. But it's interesting if we break this down to a 4-hour chart for a little bit more granularity. You can see here the bulls are pushing higher this morning. I didn't see any headlines in my research this morning, but it looks as though the bulls are pushing higher. Again, this was bought at the 50% retracement. So if you anchor the fib on, let's say, about the 7th of January here, to the top, you can see that there was a bit of sideways consolidation, which on the 4-hour chart came into the 50-period moving average, and we've pushed higher. So this is kind of interesting here because this is quite bullish that the bulls that have come in and bought at the 50% fib retracement. And so at this point, if that indeed is the case, one could argue, hold on, let me just try and bring up some technical stuff here. One could argue, just sort of hypothetically, that the measured move now, if the bulls continue going with this, could be a retest of that previous high at 62.25 in the front contract here, which I believe is the January contract, and even the measured move would be a little bit higher. We could push into new highs at 63.64. So that's going to be a very interesting one to look at. On the other hand, hold on, let me just take this off. Oh, where is that? Oh, yeah. So on the other hand, what did the bulls need to do? Again, as I always like to do, I'm just going to measure the first hurdle for the bulls here. They need to clear this 38% fib, which also nicely lines up with the recent sort of swing high at about $60. So $60 is a really key level because that's the first significant overhead resistance. If the bulls can push through that, it's looking good. They then have to push through the 50 at a 60.50, then $61. But so that's going to be the key level I'll be looking at this morning, is the $60 level, to see if this is legitimate or not. We shall see. Finally, let's just have a look at some of those crazy metals. I just want to show you in terms of the metals, just the volatility. It's getting very hard to trade here because if we look at something like silver, just pulled out a chart from Bloomberg on silver volatility. So this is the, you can see it's the 1-month volatility. And you can just see now we're up to 75, and you just see how the volatility in the silver market is basically, I don't know, sort of doubled or tripled over the last couple of months or so. So it's very difficult to be trading futures. We saw overnight that the in China that futures margins are sort of increasing there. So definitely there's a sense to try and calm down this speculative market. I don't think it's justified at this point. And with the volatility at these high levels, it's definitely targeted funds will be reducing their exposure just because the volatility is too high. So let's just have a look at the charts. Actually, I'm throw it up on silver, the silver futures here. So can it continue? Yes, but I think the only way to really participate is to be looking for really good levels to come back in, sort of Fibonacci retracements, that kind of thing. And because implied volatility is so expensive, it's very it's sort of prohibitively costly to be buying, let's say, a sort of a long call or something. Or at the minimum, you need to be selling some volatility, so some kind of probably a very tight call spread is really realistically the only way to be doing that. And because the margins on futures is so high, you probably want to be looking at something like the SLV or something like, whoops, hold on, where are we? Metals, something like the SLV. But even there, as I say, implied vol is high, so call spreads. So interesting to see where that goes. I think I'll leave it there, guys. I've already spoken too much. So have a great weekend, a great trading day. Not a huge amount of data today. Let's see if there's any headline risk. There is some talk still. Historically, so to speak, Trump has launched military action generally when the markets are closed. So that's over the weekend. Let's keep an eye. There's still a lot of amassing of U.S. forces sort of in the Gulf region. Some of the aircrafts aircraft carriers are steaming there. So although Trump has ruled out sort of military action on the Iranians, and the Israelis don't seem to want it, and the Gulf states don't seem to want it, I still think it's higher than a zero probability that this weekend there could be some sort of action there, which of course would cause a spike in the oil market. So hey, if you want to do a deep out of the money long call option on oil or USO, that could be an interesting sort of fun speculative play over the weekend as well. Take care. Have a great day. Have a great trading day. Great weekend. I'll be back next week with the macro snapshot. Thank you.